Welcome back to the deep dive, where we tear through a stack of research and, try to distill it down to the insights you can actually use. Today, we are diving fork first into Specialty Restaurants Limited. They're a massive player in the culinary space. And we're using their recent Q2 FY26 investor presentation, plus some pretty sharp market analysis and technical stock signals.
That's right. And our mission today is, well, it's very specific. We're looking at a company that is driving some phenomenal growth. And they're doing it through one of the most diverse portfolios I think you'll find. I mean, they run everything from these 30-year-old heritage fine dining rooms to like modern burger joints. We need to see how that impressive operational expansion holds up when it hits, the real world. Market volatility and the cold, hard, bearish signals we're seeing on the stock chart.
And here's the core tension, the nugget you need to hold on to before we get into the data. Despite all the disruption the hospitality sector has faced, Specialty Restaurants has achieved its, get this, 17th consecutive quarter of sustained profitable growth. They're executing where it really matters, on the ground, in the kitchen, at the cash register. So we need to figure out why the market doesn't seem to be rewarding that consistency.
Exactly. That 17-quarter streak it's an astonishing benchmark in this industry. It proves they've successfully navigated the whole post-pandemic landscape. But, success on the balance sheet doesn't always equal success on the stock chart.
Okay, so let's unpack their core strategy first. Fundamentally, they're built around market leadership in the Pan-Asian and Oriental cuisine segment. But they don't stop there.
No. And what really defines their strategy, and frankly, their unique selling proposition, it's not just what they sell, but the sheer variety of how they sell it. They've got formats that span, well, everything: fine dining, casual dining, resto bars, cloud kitchens, even confectionaries. This operational hedge is just so crucial because it lets them target wildly different price points and demographic groups all at the same time.
That sounds like a fantastic strategy for resilience, right? If one segment, say fine dining, hits a rough patch,
Right.
the casual or fast food side can pick up the slack. So beyond that diversification, what are the central pillars keeping that 17-quarter streak alive?
It really boils down to two things: relentless cost control, which is just essential in a sector with such thin margins, and enhancing the value proposition for every single guest. They get that competitive pricing alone isn't enough. You have to offer superior experience, whether that's through innovation or pure nostalgia.
That makes sense. Let's talk about where the revenue is actually coming from. The presentation highlights that home delivery is still a significant proportion of total revenue. But I do wonder, is delivery starting to cannibalize their core dine-in experience?
That's the key question, isn't it? And the Q2 FY26 numbers, and these specifically exclude their confectionery arms like Sweet Bengal, they offer a pretty definitive answer. While delivery is massive, the in-restaurant experience is fundamentally stable. It still dominates. Dine-in sales made up 75.7% of the revenue. That's 7,298 lakhs. Delivery sales were the other 24.3% at 2,343 lakhs.
So roughly 3/4 of the revenue still relies on people physically walking through the door. And that ratio really proves the need for their expansion and refresh plans. They're not just adding new spots like Siciliana and Walters, they're fundamentally upgrading the appeal of their flagships.
Precisely. The mainland China and Asia Kitchen brand refresh. That's not just an aesthetic choice. It is a massive strategic investment. They're trying to future-proof their top earners. The whole idea is to directly improve same-store sales growth. In this environment, you can't just rely on 30-year-old decor no matter how beloved the food is. It'll eventually slow you down. They're being proactive.
Which brings us to the sheer scale of this whole operation. The brand variety it's genuinely a study in portfolio management, running a group that spans decades of tradition right alongside these, modern experimental concepts.
It demands incredible logistical agility. I mean, just consider mainland China, their 30-year-old flagship. They put it through a complete makeover. Ambience, decor, menu. They're adding unique and trending dishes. But crucially, they stress retaining that precise blending of spices, what they call the yin-yang flavors. They're trying to modernize without alienating their core patrons.
And the cost of that balancing act must be immense. Contrast that with, say, Calcutta. That brand is less about adapting and more about, well, preservation. It's positioned as a traditional fine dining experience, literally recreating the lost taste of the 300-year-old recipes of Calcutta's culinary heritage. It's selling history.
And then they just pivot completely to catch the next generation. Asia Kitchen by mainland China is the semi-casual evolution. It was created specifically to offer diverse Pan-Asian food, Hong Kong, Singapore, Thailand, Korea, in these high-footfall mall locations. It's for a younger, faster-moving diner.
So that's three completely different approaches for three different segments.
Yep.
And they also have concepts that really rely on theater. You have the barbecue specialists, Sagri Global Grill and Flame and Grill.
Oh yeah, this is an immersive, unlimited offering. It's
Yeah.
all about the grills and kebabs from Mediterranean to Indian regions.
And speaking of theater,
You can't overlook Jungle Safari. This is dining as pure entertainment.
a wild dining experience with thick foliage, tree trunks, flickering lights. It's like a tropical paradise.
The specialized maintenance for that alone must be substantial.
It's amazing, a theme park experience with fine dining. But what about the newest concepts? Siciliana, for instance. It's a refined tribute to southern Italy.
Right, focusing on minimalist design and these bold, earthy flavors.
And then there's Walters. This is maybe the most fascinating example of their R&D.
I agree.
Walters aims to elevate the fast food experience, and they dedicated resources to refining the actual bun bread.
I know. Their goal was to make sure the bun contained the fillings and kept its integrity for one-hand eating. That level of technical focus on a fast food product tells you they're serious.
The fact they managed the supply chain to perfect 300-year-old Bengali recipes, the complexity of a live grill, and the integrity of a fast food bun all at once is just staggering.
Yeah.
And we should quickly mention their international reach, too. Sharangi in London won the Open Table Diners' Choice Award.
Highly praised.
And locally, their confectionery brands, Sweet Bengal and Dariol, just round out the entire package. It's a remarkable operational achievement.
It really is. But now, let's pivot and see what happens when that operational success runs into the harsh reality of quarterly financial scrutiny.
Let's ground this in the Q2 FY26 review. The top line looks undeniably healthy, right?
Absolutely. Revenue from operations was 11,643.8 lakhs in Q2 of 26. That's up from 10,437.77 lakhs a year ago. That's a robust 11.55% year-over-year growth. And profit after tax, or PP, saw a really significant leap. It's at 446.55 lakhs this quarter, compared to just 284.96 lakhs a year prior.
That PP growth is impressive. The company credits this to operational efficiency and cost absorption. Can you break down that efficiency improvement for us?
Sure. So we saw the operating profit, and this is excluding other income, rise to 19.28 crore. That gives them a margin of 16.56%. And crucially, that's an improvement of 189 basis points year over year.
189 basis points.
Right, which for our listeners, that's an improvement of 1.89 percentage points in their operating margin. It reflects smart scaling and better cost management.
Okay, so that sounds like pure positive momentum. It validates the 17 quarters of growth. Where's the complexity then? Where's the risk the market is reacting to?
The complexity is in the volatility. This is where investors get nervous. While the year-over-year performance is strong, the Q2 FY26 net profit of 4.61 crore was actually down slightly sequentially, quarter over quarter.
Why the dip if the core operations are getting more efficient?
This is driven by non-operational noise. We're seeing fluctuations in other income, interest costs, and depreciation charges affecting the quarterly report. So analysts are concluding that investors should expect growth with choppiness. The underlying trend is good, but the margin volatility, it just undermines the market's confidence in predictable growth.
So the engine is powerful, but the road is bumpy. Got it. Before we move to the stock chart, which brands are carrying the most weight?
The standalone Q2 data shows 3 brands contribute over half the core revenue. Mainland China is at 24%, Egypt Kitchen is 17%, and Calcutta is 13%. In terms of physical footprint, they're at 123 total units. Interestingly, Sweet Bengal is the largest by unit count at 32.
Which makes those brand refresh efforts even more critical. They have to protect the top revenue generators.
Exactly.
So given those strong fundamentals, 17 quarters of profit, double-digit growth, we have to confront the uncomfortable truth. The stock chart does not look healthy.
It doesn't.
Let's shift to the technical analysis. Why isn't the market celebrating the success?
This is the cognitive dissonance an investor faces.
Yeah.
If you look at the stock's daily chart over the last year, the structure confirms market skepticism. The price action has been a clear downtrend, followed by this protracted, choppy, range-bound consolidation. It's basically trapped between 120 and 140.
That sounds incredibly frustrating for anyone holding the stock. What are the key technical barriers preventing a bullish reversal?
The biggest one is the 200-day simple moving average. It's sitting right around 137. The price has been trading below this average for months. That confirms a persistent bearishness, and psychologically, 137 is now seen as a major brick wall.
And what about momentum indicators like the RSI? Is it suggesting that buyers might be getting ready to step in?
Well, the current RSI is sitting around 41, which is consistently below the 50 mark. This indicates, mildly bearish or just neutral momentum. It's not oversold enough to trigger a rapid bounce. But more concerning, really, is the volume profile.
Okay, tell us about the volume. Is there any quiet institutional accumulation happening?
Not at all. Volume has been extremely low during this consolidation. Low volume and a sideways move suggest a crucial lack of interest. The big buyers are not accumulating yet. The only times we see real volume spikes are on major selling days. You see these large red candles in February, August, and October. That's forced selling. The market just isn't ready to trust the fundamentals.
So if you're looking at this stock, what are the immediate strategic insights? What levels should you be watching?
The stock is technically weak, plain and simple. I'd say aggressive long positions should be avoided until there's a clear, sustained bullish trigger. You need to watch two numbers. Immediate critical support is at 125. A decisive close below that, especially on higher volume, could trigger a sharp downside move.
And on the flip side, what's the signal for a legitimate entry point?
You need to see a sustained close above that crucial Euro 137 mark, the 200-day DMA. And it has to happen with above average volume. Without that volume confirmation, any move above 137 will likely be a brief fake out before sellers just push it right back down.
That puts the full picture into sharp relief, doesn't it? Well, we've covered a company that's executing brilliantly on brand innovation, expanding geographically to places like London, Dubai, and Oman, and delivering 17 straight quarters of profit growth.
Yet, that success is completely overshadowed by internal margin volatility. And the market reads that as risk, which leads to the external technical weakness we see on the chart. The long-term analyst view is pretty consistent, though. The company is positioned for steady improvement, but investors have to prepare for this near-term choppiness.
Which brings us to our final provocative thought for you to mull over. Specialty Restaurants manages this portfolio with 30-year-old fine dining brands like Mainland China and, Calcutta, right alongside hypermodern concepts like Walters. So, given the intense effort required to refresh and maintain those complex legacy brands versus launching entirely new, streamlined concepts, which segment heritage or innovation will ultimately be the deciding factor for their long-term growth and their margin stability?
It's a real portfolio management paradox. The heritage brands give you brand equity, stable revenue, but the innovation labs like Walters might give you the margin stability and the scalability that the stock market is just desperately wants to see. It's a bet on nostalgia versus novelty.
Something to think about the next time you choose a restaurant. We appreciate you taking this deep dive with us. We'll see you next time.